So obviously, Craig, you mentioned there one of the biggest advantages of buying off plan is getting, an amazing price. Can you not get that with a completed property?
That's a really good question. I suppose you could, but generally speaking, if you've got something which is completed and it's being listed for below its true market value, 9 times out of 10 it means that there's work that might need to be done. There might be an unresolved issue and extra capital might need to be spent. So for certain investors who are looking to be hands-on, maybe people in the trade who are experienced, maybe they can get a completed property below market value, but the only way to guarantee consistently below market value prices with a quality product, again with all of the benefits you mentioned in terms of build warranties and being built to modern standard, off plan for me is the way to go.
So I don't know about you, Craig, but a question I'm often asked is, should I be purchasing this with a mortgage or should I be purchasing this property with cash?
Yeah, you're right. That's something that I'm asked a lot. It's a very, very common question. This kind of links back to the very first thing that we mentioned when we said you need to figure out what exactly it is that you're trying to achieve. Are you looking to chase yields? Are you looking for capital appreciation? On the face of it, interrupt if you disagree. I think that most people feel that if they have the cash to buy a property outright, they feel that will maximise their yield because they're not paying the mortgage costs. Kind of makes sense. But when you look into it, let's say, for example, you had £100,000 and you could divide that into 4 chunks and buy 4 properties with a mortgage, putting a 25% deposit down and borrowing 75%. That way, even though you're going to be paying mortgage costs on each of those apartments or houses, you would get the capital appreciation on 4 properties instead of 1. And even if your rental income halved because of the mortgage payments on each property, well, you'd have 4 lots of a half. So really, when you look at it and you look at the maths, if it's possible, financially speaking, it's better to mortgage and leverage always.
You mentioned leverage there. Can you just explain what that means, leverage?
Okay, so leveraging is another term for mortgaging. It's where you put in a certain portion of the money and then the bank put the rest in. So you're using just a small portion of your funds to buy something of a much greater value. So again, just to elaborate on that a little bit more, if say, for example, you have a property that you're purchasing for £100,000, we mentioned before that if you get a good price, it could be 20% below market value. Well, if you're only having to put in 25%, which would be £25,000, and that property goes up in value to 120, the actual return on the capital you've invested is much, much greater on the mortgage route, where if you've put in 100% of the money, all £100,000, and it still goes up 20, the return on the actual capital invested as a percentage is much, much smaller. Have I explained that well enough? Does that make sense?
Yeah, it makes absolute sense, yeah.
So for you, what would you say the majority of your investors go for? Mortgages or cash purchases?
Again, just talking about what you said earlier on, it changes for different motives, but I find the leveraging is definitely more popular for me. People like spreading their cash out across multiple properties because it's important to remember when you're investing in property, again, you're not just getting one income like you are with other investments. You are getting a rental income and capital appreciation. So if you can maximise both, that's the way to do it, I think.
It's quite rare. There aren't many other investment types that offer a double bubble, as we say.
Yeah.
One other thing that I would briefly mention also, I think this is quite important, certain property types are not eligible for mortgages. When we look at things that are too small in size, below 30 square metres, student property is another one.
Of course, yeah.
So you can't always mortgage, some things have to be cash, but I think if you're buying a residential property above 30 square metres, there's no commercial below, etc., subject to an individual's own personal circumstances, mortgaging tends to be the way to go.
Yeah, definitely. So a lot of our investors are purchasing through limited companies. Can you sort of elaborate on what that means?
Yeah, you're right. There's definitely been an increase in that. I think that's since, I believe it was George Osborne, who was the Chancellor at the time. He changed the rules on interest rates with mortgages and whether or not that was a legitimate business expense to deduct from profits of buy-to-let landlords. To explain a little bit better, if you own a buy-to-let in your own name and you have a tenant paying £100 a month for round figures, and your mortgage interest is £20 a month, you're no longer allowed to deduct that £20 from the 100 before working out what your tax liability is. So you pay the tax on the 100 and then you still deduct the 20. The difference between owning a property as an individual or as a company is that interest rate, that mortgage interest rate, is tax deductible. So you would deduct that before working out what your tax liability is. So in that regard, it can be more efficient for somebody to own a property as a limited company. However, as a bit of a disclaimer, this is definitely the remit of an accountant or a tax advisor, and everybody's individual circumstances are different. There are variables such as the rate of tax you pay, whether it's 20% or 40% plus, and that will also have a knock-on effect as to whether it's more efficient to do it down the limited company route or the individual route.
Okay, so we've got an investor now, might watch this video, still unsure about all of the questions that we've answered, etc. How would they start off getting a property for themselves for investment right now?
Do you know what's funny? I would say that most investors, when they contact us, are in that exact same position. They might be able to answer some of the questions, but not all of them. And then that's ultimately why we're here. That's the purpose of an agent, to walk you through the process and help you find the right investment for you. So my advice would always be, if you're unsure, contact a local property agent and use their expertise, see what they can recommend. But obviously, not all agents are equal. Naturally, we're gonna talk about ourselves as being the best around, and I think that's warranted. But what would you say that people can do to make sure that they are working with a reputable agent?
It's got to be, first of all, due diligence, hasn't it? Look for the main things. Do some research on the company. Check for reviews. Go to their offices, meet and greet them. That's how I personally operate. Making sure that they're all above board is definitely on the priority list. Let's spin it round as well and say, what if there's an investor right now who does have or believes they have all the answers to the criteria? Mm-hmm. Should they still contact an agent? Can an agent benefit an experienced investor?
Oh, definitely, because even if you know the answers to all of the questions, you might not necessarily be abreast of all of the latest opportunities, and you'll know from your own experience that as one of the biggest off-plan investment companies in the UK, Completed Properties also, we have a very, very good relationship with many of the property vendors and the developers, and we often find out about opportunities long before they come to the market, not to mention the special deals and rates that we can secure. And even for the people who think that they know everything, there's always a thing that you've overlooked or maybe not thought of. Sometimes you can think you need or want a certain thing and something else might be better. So definitely speaking to an agent is fundamental to success, I would say.
And just touching on that point there, I suppose exclusivity that agent can bring you that you might not be aware of. So can some agents have that over other agents? How would that all work? Would you say to someone who doesn't understand certain types of agents and what they can bring to the table from that side of it?
Yeah, definitely. Some agents will have exclusivity on certain developments. So if they've built a formidable reputation, certain developers will then work with them exclusively, whereas other agents who maybe don't have that same reputation wouldn't have access to that stock, so to speak. Again, it all comes back to working with a big, reputable agent.
If you like what you've seen in this video or have any questions about investing, fill out your name, email and contact number in the link in the description below, and myself or Craig will contact you directly to discuss your needs further.